Well, thank you, Carl, and thank you, Chain DLX and Digital Davos for having me as part of this discussion. First off, just a brief disclaimer, this is not financial advice, tax advice, or legal advice, so please consult with a professional in those fields before making any decisions about your own unique situation. Now, we discussed last time around the crypto asset space, and we talked about how, despite popular opinion, most crypto assets are not Ponzi schemes. Most cryptocurrencies are aiming to solve one or more problems in the world. Many of them serve as a store of value or as a currency. Some of them are addressing use cases and issues within the health, real estate, software, or other arenas. Also, we talked about how crypto tends to exhibit low to no correlation with various asset classes. Here's a bit of a further review of that. It's not really all that different, crypto, from various traditional markets, but it does operate on a different cycle from most other markets, including the gold market, the stock market, and the bond market. Now, as we discussed in the last seminar as well, cryptocurrencies are a promising emerging asset class. They come with high risks, but also with high reward. Now, many investors are increasingly turning to cryptocurrencies as a viable hedge against other asset classes, such as stocks, bonds, and gold. This has been increasingly including sophisticated investors, institutional investors, high net worth individuals, who are also considering this as a viable hedging solution against currencies such as the US dollar and the euro, given that cryptocurrencies in many cases have a fixed supply or a more limited supply than their national currency counterparts. Ultimately, the same fundamental investing principles apply to the digital asset space as to any of these other asset classes mentioned. There may be different cycles to the cryptocurrency market, but fundamentally, the principles involved should be the same. There should be a sound investment strategy, and there should be proper risk mitigation procedures implemented in order to properly and responsibly invest. While cryptocurrency may be an emerging market and there may be new terminologies, new technologies, investment decisions around cryptocurrencies, like any other asset, come down to questions of fundamental value. It is important to look, when evaluating crypto assets, at major components, such as their functionality as decentralized databases, their functionality as currencies, their functionality as service providers, and their potential for usage of applications within their networks. Additionally, some factors that we like to consider include competitors to that particular digital asset, strategic advantages of an asset such as IP or barriers to entry, disruption potential within the niche that that asset serves, distribution of that asset across exchanges, as well as the volume and price history of that asset. Examples of infrastructure risk could include having too much cash in the bank or having too many stablecoins. Part of CKC's risk mitigation in this regard is to avoid long-term storage in either of these assets and to focus on holding short-term bonds when needed. Other infrastructural risks can include exchanges, and part of CKC's approach, for example, is to move assets off of exchanges as soon as possible and whenever possible into safer solutions such as offline storage or cold storage. So here you can see the value of Bitcoin going up significantly, in fact, over the last couple of years. And over the same time period, you can see an increased risk of bank failure. Crypto in this time frame, however, was a good choice. And over the last 5 years, you can also see that Bitcoin has significantly outperformed the stock market. It's also relevant to consider 10-year Treasury yield patterns and how yields have dramatically shifted over the last several decades. And in particular, the immense levels of volatility over the last couple of years that were not happening at the time in the crypto industry. In this example, a 30-year treasury position lost 30% of its value from 2020 to 2023, whereas in the same time frame, Bitcoin's value increased dramatically. Relatedly, here you can see that a 30-year $100,000 bond with maturity at 2050 is now worth $58,000. Ultimately, the risks in crypto have been comparable to many of those outlined in the assets in these examples, while crypto has in fact been showing stronger upside than many of these assets. This has been leading an increasing number of sophisticated investors to diversify into crypto as a hedge against unrelated risks in these other asset classes. If you'd like to learn more, or if you have any questions about the crypto asset industry, I'd love to continue the conversation with you. Feel free to reach out to me. My email address is david@CKC.fund. You can also check out our website at www.ckc.fund. Look forward to speaking with you. Thank you also to Carl again, and to Chain VLX and Digital Davos for the invitation.